Okay, can you guys see my screen okay? Okay. Okay, the FU candle. So the main problem that most people will face when they start smart money concepts, and especially understanding what an IFC is, that you're going to start to see them everywhere. And at every point of structure, you're going to see them at every significant high and significant low. You're going to see an IFC, or one might seem like an IFC. And then we need to know that, how do we know what is a true IFC that is going to need a mitigation, as opposed to one that is organically formed by multiple institutions or retail traders or hedge funds, etc., combining together to form organically one candle, as opposed to one singular institution putting in huge orders into the market that need to be mitigated. That is the differentiation, because from just observing, they will look the same. There's not going to be much differences between them, apart from some things I'll cover tomorrow. But in general, they'll look the same side by side, and one is going to be mitigated, the other one is not going to be mitigated. So that can lead to some sort of inconsistency. So what we can do instead is take higher probability institutionally funded candles. And one of those is the FU candle. So because of the nature of the way the FU candle is formed, we can be very confident in saying the likelihood is that was not an organically formed candle, rather it was an institutionally funded candle. Because of the nature that it was formed, we know that retail traders could not have caused it. That means institutions must have caused it. And if an institution has caused it, likelihood is that there was orders in drawdown that need to be mitigated. That is the logic behind it. Okay, so 1 second. I just wanted to pull up the chat box. I'll explain what FU candle means in a minute, as in what the letters mean. Okay, so say for example, we are seeing price action like this. We are seeing bearish price action, therefore we should be looking for sells. Now, we know that this becomes our relevant IFC. We have a bullish candle before bearish movement. And that was a leg in that's an impulse because it formed a new low. So we know that it's a relevant structural point. We know that it's a supply zone, and we know that there is an IFC potentially there. What does that mean? That if price returns there, we know that if it is a true IFC, it's going to need a mitigation. If it's a true IFC, we don't know that yet. But let's do that in black. Okay, if it is a true IFC, that's what we're going to be looking for. Now, as we approach here, so price is starting to retrace. What if it is a true IFC? Let's take the assumption that it is. Right here. So if it's an IFC, the institutional objective, now that they formed a new low, so they've taken some sort of profit or closed out volume, and now the price is lower, buyers are introduced into the market. So now we're going to start to see some sort of retracement. The hedge fund or institution that caused that IFC, sorry, the hedge fund or the institution that created that IFC, what is their objective? The objective of that institution is to bring price back up to here. Why? Because they have orders in drawdown which need to be taken care of. They want to close out those orders that are in drawdown. They want to mitigate those orders. They want to take them out at break even before a new low is made. Why can we anticipate a new low? Because that is with trend, right? We are in a bearish market, so we can anticipate a new low. Unless something happens here and we are seeing some sort of accumulation or some reason for it to shift trend and become bullish. But let's take that out of the equation for now. Let's assume we're in a bearish market, is going to continue bearish. The institutional objective, or the objective of the institution who created the IFC, is they want to have a process of mitigation. And when is that objective set? That objective is set over here at the beginning of the retracement, that they know that when price is starting to retrace, their destination, their desired destination is the IFC, because they want to take care of those orders that are in drawdown. That is simply the objective. The reason I mentioned that is because of this, is the creation of the FU candle. So just bear in mind everything I've said for now. Now let's switch to a retail perspective, just for the time being. We see a trend line. We can pull a Fibonacci from here to here, 61.8, somewhere like this. Let's throw in an EMA, doing something like this, blah, blah, blah. So right here, what do we see? We see a zone of confluence where we have our fib level, we have our trend line, and we have our EMA. They are all telling us we should be looking for sells over here, right? So the retail logic is this. Retail logic is to get to that point where there's the 61.8 and the trend line and the EMA, etc., and look for a sell. Now, if that was to play out, the IFC that was over here, and if it was a true IFC, was left unmitigated. So the orders that were in drawdown here are now in greater drawdown over here because they were not mitigated. So they're now getting in further loss. That is an undesirable outcome. That is something that the fund that created the IFC, that is something that they do not want to happen. They would much rather price comes back up, mitigates, and then continues down. That is a desirable outcome. So now, if we are factoring that into consideration, can we see that this right here, with a retail perspective, how likely is that to happen if we know that this IFC needs to be taken care of? That's just one proposal, one question I'm placing. There's no correct answer to that right now because we don't have enough information. But if price continues to develop like this, what are we seeing here? So remember, this was our trend line, 61.8, etc. EMA, blah, 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 and pro trend. So this would be considered a golden trade for a retail trader, where we have a trend line, EMA, Fibonacci with trend. That's all anybody can ask for from a retail trader. And now they waited for a triple top. So now what is retail traders going to be thinking? That I should have entered here and put my stop losses somewhere over here, and I'm looking to take a sell. And I'm looking for a 3-to-1, 1-to-3 risk reward trade or something like that. That is the retail analysis. Now, what are we seeing that as? Now that I've taught you some things today. We can see that instead as now that has become equal highs. That triple top has shown us that we have equal highs. And what does that mean? Equal highs means money. What does that mean? Now, what I'm about to show you is what I considered, creating the story of the pair. We considered what the retail analysis would be. We are now considering what the institutional objective is, being the IFC over here. And we are now understanding the interaction between both and how we can capitalize upon that. So the retail trader that is looking to enter here, their stop losses are over here, right? So if price is to do something like this, why did that happen? From a retail perspective, that's going to be considered a stop loss hunt. That the bias that they had was correct. It made a new low, and the only problem was it took out the stop losses. It did a liquidity hunt, or stop loss hunt, sorry. It did a stop loss hunt, and then it continued to do what they wanted to do. So retail traders are left kind of confused, a bit frustrated, and they don't really understand what happened. But what can we see? We can see that from the get-go, the desired outcome was to bring price up over here to mitigate the IFC. So we can understand why that happened. Despite the EMA, despite the trend line, despite the Fibonacci, despite the triple top that was happening over here, it all failed because we know that there was an IFC over here that needed to be mitigated. And furthermore, we had liquidity lying over here, and liquidity is what price is attracted to. So price shot up, took out that liquidity, mitigated the IFC, and then continued down. That is what's going on over here. That's the logic and the story that's going on. But let's take it a little bit further. Okay, let's break down a little bit what's actually happening over here. So when price comes up and does that, and there's a mitigation over there, what has happened? The sellers that entered over here looking to sell, their stop losses are lying here, as we discussed. Now, also, what can we appreciate? We can appreciate that this was a resistance level, right? And because of 1 touch, 2 touch, 3 touches. 3 touches tells us that's a resistance level. When price comes up, we've had a break of structure, which equals resistance turns into support. So now that same resistance level has now turned into a support level. We've had a break, and now what do retail traders do when you see a break of structure or you see a resistance turn into support? They're going to be waiting for that retest and then continuation. That's the logical situation, because they're now seeing, I was looking for a bearish scenario. We had this relevant structure point. We had that triple top. That triple top was taken out. Break of structure, test, break, test, continuation. That is a very retail scenario, and that's something that is very, very rudimentary when we start to learn to trade. Now, they are therefore buyers. Where are the buyer stop losses? Right here. The buyer stop losses are here, and the seller stop losses are over here. So we have 2 sets of stop losses. So the FU candle is this one. Price shoots up, mitigates the IFC over here. So we have that price shoots up, and what does it do? It takes out the sellers in the market. It takes out the seller stop losses, does a mitigation, and then continues down, right? And makes a new low, etc., etc. So from an institutional perspective, what has happened? The institution has taken out liquidity of sellers because of these stop losses that were taken out. It has also taken out the stop losses of buyers, of the buyers who were thinking of a break, retest, continuation scenario. Those buyers' stop losses are taken out. So what has happened? Buyers and sellers. Those are the only 2 situations in the market. You can either be a buyer or a seller. In this situation, the buyers took a loss. The sellers took a loss. So everybody's losing. Who's winning? The only person that won was the institution. So retail traders and people who are not informed will take a loss. Institutions and people who are creating this take a win. So the reason why it's called an FU candle is, to put it bluntly, it's a fuck you candle, is because everybody in the market who does not know what's going on both buyers and sellers take a loss, despite what the analysis is telling you, because you did not because you did not understand the concept of there was an IFC there that needed to be mitigated, and this was simply engineered liquidity. Liquidity was formed into the market, and this was not a stop loss hunt, rather it was a mitigation. And the slight differentiation we need to understand is this. This can be considered a stop loss hunt. From a retail perspective, they could say my bias was correct, but the market maker did a stop loss hunt to take out my order, and then continued in the way I wanted to happen. Now, as I mentioned earlier, institutions will not go out of their way to take retail money. Why? Because the average retail trader is trading between 0.01 to 1 lot size. Very small amount of money involved. So the amount of money that it costs to push price like this, to create that FU candle, is going to cost the institution a lot of money. Their risk is quite high to do that. What is their reward? Their reward is quite low. To go out of their way to take retail money is not worth it. However, if they can take money, if they can do a stop loss hunt that is not out of their way, but it's along their way. So they were going here from the beginning anyway. That was their plan, because they need to mitigate the IFC that was in drawdown. So if along the way they pick up some extra liquidity, they're going to do that, but they're never going to go out of the way to take liquidity. That's the differentiation. So stop loss hunts do exist, but not in the way that is traditionally taught. Does that make sense? I'll explain now. I haven't actually told you, Michael, what the difference is between an IFC and the FU candle. I'll show you now. I just want everyone to understand the thought process and the wisdom and what's going on in the formation of this candle, if that so far makes sense. But an FU candle is a form of IFC, which is more reliable, which I'll explain now. I created this back in September, and I just call it the 3 M's. Let's do like this. Means, motive, and mindset. Okay, so this is the FU candle. So we've discussed how the nature of the FU candle is to take out liquidity and, is to take out liquidity by taking out the stop losses of sellers and inducing buyers prematurely or falsely. It's to induce buyers falsely because of that resistance, support. We have a break, retest, continuation. They will enter here and their stop losses will be here. So that is the fallacy of buyers who are falsely entering the market, because they thought that this was a break of structure to be bullish, when in reality it was not a break of structure, it was a run of liquidity. So the FU candle is formed to take out the liquidity of sellers, take out liquidity of buyers, and mitigate an IFC. That is the purpose of a FU candle. Now, look at these 3 M's, means, motive, and mindset. If we are seeing this as, let me actually make it a little bit bigger. Okay. Remember this, the situation where I said this is the 61.8 double top, the trend line, the EMA, etc., etc. This is a zone of retail confluence where retail traders will be looking to enter. And that is what every sensible retail trader would do. Based on the information they have, they'll be looking to enter based on these confluences. Now, here's a little side tangent that you can look into. If you go onto Google and you type in my FX book community outlook, or just type in community outlook Forex in general, you'll be able to find a bunch of pages. My FX books is the one I generally use, where you can actually see the sentiment of what retail traders are doing. So if we were to look at this right here, a situation like this on my FX book community outlook, you'll be able to see that in a situation like this, because it's so high confluence, you might see something like 90 to 95% of people selling. And these are published on the website, and they come from broker feeds. So it's actually it's accurate information because it's coming directly from the broker that is linked to that MyFX book. So Oanda, I think, is linked to MyFX book, and also FXCM. So from those two feeds, you're going to see, and it's going to tell you exactly based on that broker, how many positions in terms of lots, how many positions are buying in lots, how many positions are selling in lots, what is the average price point of the buy, what is the average price point of the sell, what percentage of people are long, what percentage of people are short, what percentage of those people are in drawdown, etc. That all of that information is available. So we can use that to our advantage because we know that generally speaking, 90% of retail traders lose. That is a broker's statistic. 90% of retail traders lose. So therefore, if we see a situation where 90 or 95% of people are selling, and in conjunction with me seeing an IFC over here, I can confidently say that because we know that majority of retail traders lose, and because I have a reason to believe price is going to come back up to here, that gives me confidence in anticipating there might be an FU candle. I don't trade the FU candle, I wait for it to form, and then I trade it after the fact. But let's talk about the 3 M's before I forget. The first one is means. So over here, if 95% of people are selling, who has enough capital to push price up? Certainly not retail traders. If 95% of retail traders are selling, that means the 5% of the remaining retail traders that are available, that are buying, they have enough volume to buy and take over all of the volume of the sellers and also of the institutional people who are selling too, also funds who are selling. Retail traders simply do not have enough capital. They do not have the means to have that kind of impact in the market, to go against general sentiment so heavily. They do not have the capital to influence price like that. The first M is this. Even if there is 20% of people or 30% of people buying here, let me just get this person in. Even if there's 20 or 30% of retail traders buying over here, they simply do not have enough money or capital to take over the remaining people who are retail traders, and then the institutional money also. So we know that if price shoots up over here, we know this push up over here was not caused by retail traders. Likelihood is, because of the reason of capital, we know that that is more likely an institutionally funded move. That move was funded or paid for by an institution. That's reason number 1. Reason number 2 is motive. Does any retail trader at a double top, over here, double top, on a 61.8 or whatever confluence, it doesn't have to be a 61.8, I'm just doing that for the sake of example, but does any retail trader buy at resistance? Nobody buys at resistance. So nobody has the motive to buy over here. Everybody is going to want to sell. Logically speaking, everybody wants to sell over here. So who is buying up to here? The only people who have the motive to do that is the people who formed this IFC, who decided over here that price needs to return to mitigate their IFC. So who has the motive to do that? Only the institution. So the institution does have enough capital. Motive. And the last one is mindset. The mindset component I created was more like, the whole thing about liquidity of equal highs and equal lows. Retail traders don't really think like that. They're not looking to sorry, that says buy at resistance. Retail traders, they don't have the motive to buy over here. This is a resistance level. Everybody's going to want to sell at a resistance level. Nobody comes to a resistance level and decides to press buy. Everybody wants to sell at resistance because they know that is a cap in the market that is previously respected. So therefore, likelihood is it might be respected again. So people will only buy once that resistance level is broken. So break, retest, continuation. But the FU candle takes care of those buyers too. So both sides are covered. So means, institutions only have the means to do that. Motive, only the institutions have the motive to buy at resistance. And the last one is mindset. Mindset being the whole liquidity stuff. Mindset being that they can free up the liquidity of sellers. They can free up the liquidity of break retest traders. So the stop losses that were here, they take those out. And the whole process of the FU candle. So everybody is taken out of the market except for the institution. And only the institution can really do that. So let's clean up this. Does that 3 M's make sense? Because I need to delete some stuff to make it a bit more clear. Does that all make sense so far? So they are inducing retail and stopping them out. Exactly. They didn't go out of their way to take the retail traders' money. Rather, they induced sellers prematurely. And when the formation of the FU candle happened, they took out those sellers who were selling prematurely and induced buyers and took out those buyers too. So every retail scenario was taken out of the market. That liquidity was therefore freed up and went into the pockets of the institution. And the institutional objective, which was to mitigate that IFC, was also taken care of. So at the end of the day, the real winner is the institution and the real loser is any retail trader who didn't know what they were doing. Okay, looks like everyone's made sense. Motive, buy at resistance. Nobody buys at resistance. Everybody sells at resistance, unless the resistance is broken and turned into support. So the motive component shows us that if there is a bullish movement at a resistance, the likelihood is a retail trader did not cause that. Likelihood is an institution caused that. So therefore, we can say more confidently that was an institutionally funded move. Therefore, we can more likely find an institutionally funded candle. So that's what I'm going to show you now. I want to get rid of some of these drawings. Okay. So we've discussed the wisdom behind it. We've discussed how they're created. We discussed the interactions that are going on and the logic behind all of these interactions. Now, what is the what is the FU candle itself? The FU candle is right here. Okay, so say for example, price is right here. We've had equal highs taken out. That equal highs, when they were taken out and they had that push up, the process of mitigation and taking out the equal highs formed this candle, which is the FU candle. So that candle is responsible for taking out the liquidity, and it doesn't have to, but generally speaking, we like it if it mitigates a previous IFC, but that is not a concrete requirement. You might just see equal highs, FU candle, and then continuation. It doesn't necessarily have to fulfill this. It is just more favorable for us to trade it if it does, but it's not a certain requirement. Now, once we have that FU candle formed, we know that this candle right here is way more likely to be an institutionally funded candle because of the 3 M's, means, motive, and mindset. We know that movement in price, that bullish movement in price, could not have been caused by a retail trader because of the 3 M's. Therefore, we know it is more likely an institutionally funded candle. And what do we know about institutionally funded candles? We know that they need to be mitigated later on. So if price comes here and we have 1, 2, 3, what do we have now? We have equal lows which are formed over here, and that is a target for price. So that is one reason price, we can anticipate it to come down. If price comes up like this, mitigates the FU candle, and then continues down, that would be a nice setup. Again, this is just basic smart money. There's no refinements to this yet. I'm just explaining my understanding and how I trade them and how I apply it. But does that make sense? An FU candle is the same as IFC. These are the same thing. The only difference is that because of the nature of the way it was formed, we can be more confident in saying that it was not an organically formed candle, rather it was a real institutionally funded candle, and therefore the requirements of mitigation is more likely, and therefore that provides us a more favorable entry. So we would enter on the open, stop loss just above the candle, and that becomes a nice favorable trade. Does that all make sense? And the added benefit is that we saw, instead of just taking it blindly on this IFC, we waited for price to develop over here, and we got some lower time frame confirmations, and therefore your stop loss is likely to be smaller. That's another added benefit. One is you're more likely to have a win because you have higher confidence, and number two, if you do have a win, you're likely to have a greater risk reward because you have a refined zone, because your FU candle is likely to be a smaller stop loss than your original IFC, which could be based on the 4-hour, whereas your FU candle could be based on the 15-minute. So that's another differentiation. The stop loss you put above the wick. Yeah. Do you wait for a break of structure? Okay, the break of structure stuff we're going to cover tomorrow. It's a good question, and it's a bit of there's no fixed answer to that because it depends on the case. Sometimes a break of structure can tell us that there's a reaccumulation, and other times a break of structure can tell you another thing. So I won't touch upon that today. That's something for tomorrow, but we'll get onto that. Good question. Yeah, exactly. So once, let's get rid of some drawings. So once this IFC has been mitigated and this FU candle has been formed, what is that telling us? That there's, and remember, we were trading pro trend. The sell is pro trend. So we're in a bearish market. Now that this has been taken care of, this has been taken care of, there is no reason for it to remain bullish anymore. All of the reasons that it was retracing, the reason it was going up was to take care of the IFC. Now that IFC has been taken care of, it formed a FU candle. If that FU candle is mitigated and taken care of, and we have these equal low targets, the next place we can anticipate price to go is with trend, which is to form a new low if you're trading with trend. So that's tying in multiple things together. Don't worry if that doesn't make sense right now. We'll show you plenty of examples where exactly this happens in live charts. Can I get a list of terms? Okay, just things for your reference. Today we've covered the FU candle just now. We've also covered imbalances. So the FU candle just covered. Imbalances we covered. Equal highs and equal lows we covered before this. So liquidity. Before that we covered the concept of IFC. Like this. And other things that are worth remembering is obviously all of the stuff regarding structure and the stuff Wally covered in the morning, or earlier on, sorry, about retail. Don't worry too much about that. That was just for general knowledge. It's not something that is pivotal for what we do. But yeah, tomorrow what we're going to be doing is going over lower time frame stuff. We're going to be showing you how to apply structure on the lower time frame. We're going to be showing you our refinements on the lower time frame. We're going to be showing you how to improve upon what is traditionally an IFC or an order block or a sponsor candle or sell before you buy, etc., etc. Today we showed you what the traditional version is. Tomorrow we will show you our version of that and how it's improved. We'll also show you the improved variation of an imbalance and how you can actually trade it profitably as opposed to ambiguous and subjective, and lower time frame stuff and wick-off theory. We're going to cover wick-off theory tomorrow and maybe a couple of examples, but we'll have the whole of the next week to try and digest everything we've taught in terms of concepts. And then on day 3, we're going to be covering the whole day basically of examples, top-down analysis, our whole logic on how to manage trades, etc., etc. So that's the plan. Tomorrow we'll be starting at the same time, 3 p.m. UK time, 10 a.m. Eastern, European time, that's 4 p.m. And it should be another 6-7 hour day.
Yeah.
FU candles always, FU candle needs to be mitigated. If it is a true FU candle, it needs to be mitigated. Yeah. Yeah, exactly. The FU candle is, Blake, sorry. The FU candle is a more probable mitigation than the IFC. So therefore, we would like to take that as opposed to just a random IFC. Because we're in the business of taking high probability setups. It's not about, the thing is like, as a 3, me, Wally, and Alex, we can mark up thousands of pips a week consistently. It's not too difficult to do that. But that does not mean we make that much. That does not mean we trade that much, because it's not about that. It's about what was worth exposing our portfolio to the market to. Okay, we can anticipate there's going to be a retracement, but what if there's not a valid entry? Or what if there is an entry, but the risk reward is not justified for us? You need to consider all of these things. So when we're taking a trade, we're not just trying to understand what the market is going to do. We're trying to understand what the market is going to do in a high favorable setup that is justified for us to risk our capital. The remaining structure stuff. So tomorrow morning we're going to do a bit more on structure regarding the lower time frame, but just general structure, we have plenty of follow-up Zooms for that, because we know that's something a bit trickier to grasp. Yeah, an FU is it's a bit different to an IFC because it takes out liquidity. An FU is different to an IFC, but it is a more likely institutionally funded candle because of the 3 M's: means, motive, and mindset.